All right, let's dive right into this explainer and build out our mental memory palace. Welcome, future CPAs. If you're a second or third year BS accountancy student here in the Philippines, you already know the drill. Passing the LEGPA isn't just about passively reading the tax code, right? It's about literally hacking your brain for long-term retention. We need this stuff to stick, not just for your quiz tomorrow, but for 2, maybe 3 years down the road when you're finally sitting in that exam room. So today, we're locking down Quiz 8 coverage. We're talking sections 125 to 127 of the National Internal Revenue Code, covering amusement, gaming, winnings, and stock transaction taxes. To build this memory palace, we're going to chunk the tax code into 4 distinct zones. Zone 1, the entertainment zone. Zone 2, the digital casino. Zone 3, the racetrack. And Zone 4, the trading floor. Plus, we'll wrap it all up with a rapid-fire review to really lock it in.
Okay, let's step into Zone 1, the entertainment zone, which is all about Section 125 amusement taxes.
When you picture this zone, imagine actual physical places where people go to, spend money on leisure and social activities. Look at how mapping these rates from highest to lowest creates this super clean visual pattern. It's perfect for your brain to instantly recall. So at the very top, the heaviest tax burden is 30% for jai and racetracks. Drop down a bit to 18%, and you've got cockpits, cabarets, and night or day clubs. And hey, quick side note, the BIR includes video and karaoke bars in that 18% bracket too. Then we step down to 15% for professional basketball games, and finally, at the bottom, a 10% tax on boxing exhibitions. Remember, all of these rates apply strictly to their gross receipts, meaning everything from admission charges to TV and radio rights.
Okay, pause. Before we move on, let's trigger some active recall. I want you to force your brain to guess right now, are all boxing exhibitions hit with that 10% tax? When you try to fish for the answer before I tell you, you're actually building much stronger neural pathways. So what do you think? Is there any scenario where a boxing match totally escapes this tax? Actually, there is. And this perfectly illustrates a classic rule of 3 study hack. If a boxing match hits 3 specific criteria, it is literally 100% exempt from the amusement tax. This is such a high-yield trap for the board exam, guys. Examiners absolutely love giving you a scenario where only 2 of these are met. It's not enough that a Filipino is just fighting in it. It has to be a world or oriental championship title at stake. It has to feature a Filipino citizen as a contender, and it must be promoted by a Filipino citizen or a corporation that's at least 60% Filipino-owned. If even one of those is missing, boom, you're hit with the 10% tax. Group these 3 together in your head, and you will not get tricked. All right, moving on to Zone 2, the digital casino. This is Section 125-A, covering offshore gaming licensees.
Now, offshore gaming is super relevant in our current Philippines setup, which means examiners are definitely going to test you on this newer provision. Let's do another quick active recall check. Picture an offshore gaming operator taking bets from abroad. Do you remember the exact gaming tax percentage they have to pay?
Burn this number into your brain right now. It's 5%. Yep, just a clean, flat 5%.
But here's the catch. The real trick is knowing exactly what that 5% attaches to. It applies to gross gaming revenue. That means you take the total gross wagers and you subtract the payouts. Let me break that down for your analysis. If a problem throws total bets at you and then gives you the amount paid out to winners, you have to deduct those payouts first. That net figure is your gross gaming revenue, and that is what you multiply by 5%. Also, notice the phrase, in lieu of all other taxes. Basically, for their gaming operations, this 5% takes care of both their national and local tax liabilities. But watch out for the trap. If they make money from non-gaming revenue, that's going to be subject to regular corporate income tax and VAT.
Next up, Zone 3, the racetrack, dealing with Section 126, the tax on horse race winnings. So we already saw that the track operator pays 30% on gross receipts, right? But now we're looking at the actual people placing bets and winning. A top-tier study hack for the LECPA is contrasting general rules against their exceptions. The general rule here is a 10% tax on standard horse race winnings and dividends. But for special, high-difficulty bets like a double, a forecast, a quinella, or a trifecta, that tax drops down to 4%. Why? Well, because those bets are way harder to win. Train your brain to automatically link complex bet with the lower 4% rate.
Oh, and whatever you do, do not fall for this classic board exam trap. The bettors aren't the only ones coughing up tax money. The owners of the winning racehorses are also taxed at 10% on their prizes. So if you visualize this in your memory palace, picture 3 people paying up at the track. The operator paying 30%, the bettor paying either 10 or 4, and the horse owner paying 10. Seeing all 3 players in your mind organizes this perfectly. Finally, we enter Zone 4, the trading floor, Section 127, the stock transaction tax. This zone is all about the sale of shares that are listed and traded through a local stock exchange. Test yourself really quickly here. What is the exact fractional rate for these stock transactions? Dig back into your notes on percentage taxes.
Lock this visual in. It is 1/10 of 1%. That's 0.001. Please don't let the decimals trip you up on the exam. Literally just take 1% and divide it by 10.
Here is the absolute most crucial analytical takeaway for this specific tax. It is based purely on the gross selling price. And big red flag here, it is never deductible for income tax purposes. So for your exam prep, if a problem feeds you the original cost of the shares alongside the selling price, just ignore the cost. It's a total distraction. The tax only cares about the gross selling price. It literally doesn't matter if you gained or lost 1,000,000 pesos on the sale. If it goes through the local stock exchange, you are paying 1/10 of 1% on the gross amount. And because it's a percentage tax, examiners love to ask if you can deduct it as an expense on your income tax return. The answer is a massive absolute no.
All right, let's jump into part 5, our rapid-fire bullet review. We're using spaced repetition to build that long-term retention.
We need to move this data from your short-term working memory straight into long-term mastery. Take a mental screenshot of this high-yield list right now. Let's run through it fast. Entertainment zone, 30% for tracks, 18% for cockpits and clubs, 15% for pro basketball, 10% for boxing, unless it hits that magical 3-part exemption. Digital casino, 5% on gross gaming revenue for OGLs. Racetrack winnings, 10% generally, dropping to 4% for those crazy special bets, and 10% for the winning owners. And finally, the trading floor, exactly 1/10 of 1% on the gross selling price of stocks. If you use spaced repetition, meaning you review these exact notes tomorrow, then again in 3 days, then in a week, you are literally never going to forget them.
So as we wrap up, think about which of these taxes you found the trickiest to remember today. Ask yourself, what can I do right now to ensure I never forget it? Whether it's that 3-part boxing rule or the non-deductibility of stock tax, find your weak spot and cement it into your memory palace. Keep using active recall, keep hacking your brain, and you are absolutely going to crush that board exam. Catch you in the next explainer.